Joy Yang, Chief Greater China Economist at Mirae Asset Securities. Many thanks for joining us today. So 2% by July. Now let's ask about this figure. How much of an aberration is 4.5%? How do you explain it? You were forecasting 4.2%, so still quite strong, but to fall to 2% by July, that's a big drop.
Yes, I think when we look at January inflation, it does surprise the market. But why is that? Because when we see the January food inflation, the Chinese Statistics Department does publish 10 days and weekly data on those food items such as beef, pork, and vegetables. And for January, we don't really feel that food inflation on those items are particularly high. But yet we see that January month-on-month food inflation as a whole is 4.2%. So I think it's probably the non-regular food items, other than those meat stuff or dairy products or vegetable, that is pushing high this inflation, and that's why it surprised the market. But I still don't think that we should worry at the moment, because when we look at non-food inflation, it's still within check, and this is the true indicators of the actual inflationary momentum. But on the other side, we also see that food inflation can be so vulnerable to the headline inflation. So that's why we have to be cautious.
For the viewers, food inflation rising 10.5% year on year, non-food 1.8%. But the Chinese New Year, which came, of course, earlier this year than it did last year, how do you explain the huge distortion, 10 days, of course, being out, lots of spending, a migration of workers, etc.?
Yes, I think the Chinese New Year this time is end January. Of course, it explains why January inflation is relatively high because of the base effect. And also, I think something helped explaining the high inflation in January is that in December we do see a pickup in the fiscal spending. So this also helps explain why the consumption, the fiscal consumption is relatively high, pushing up all the prices. But we do see that inflation is going to decline and to about 2% in the middle of the year. This is because in last year we have very high inflation momentum for the first half of the year, so that's why the base effect is going to kick in and then bring inflation down to about 2% in July.
My last guest, UBS Securities, was forecasting 2 or 3, maybe 2 or 3 reserve ratio cuts this year. What is your forecast, Joy, on this figure as well?
Well, I also think that this year they will continue to do the triple R cut, because now the money generated from capital inflows is weaker than in previous years. So they have to cut the triple R to maintain a stable monetary base in the economy. So I think 3 to 4 times triple R cut this year sounds reasonable. But we also see that if the global economy continues to deteriorate, and if inflation does come to about 2%, leaving the real interest rate at about 1.5% in July, the Chinese government also have room to cut the interest rates in about the middle of the year, particularly if other Asian central banks started to cut rate for the first half of the year, since they don't want to be lagged behind.
I must ask you, prior to August of last year, you were at the IMF.
Yes.
Now, the IMF, big warning on Monday that, in fact, the European, should it go to a deep recession, stroke almost depression, then it will actually cut China's growth this year by half. To 4%. Is that too dramatic a warning?
Well,
having been at the IMF?
Yeah, I think it depends on what type of baseline scenario you assume for Europe. And to me, I think what we are worrying now is not a very negative baseline scenario, but rather it's the uncertainty surrounding the Europe situation. And you don't know if it's going to get better tomorrow or it's going to totally deteriorate again tomorrow. So that's what we worry. And that's why it calls for policy flexibility rather than a very strong, aggressive policy easing as we saw in 2008.
Are you surprised that the IMF gave that warning, though? It is a pretty big warning, isn't it?
Well, I think the IMF is concerned with the Europe situation, and also Asian economy so far is vulnerable to Europe. Particularly in China, I think U.S. and Europe added up together is almost half of the exports. But I think in China, additional downside risk is from domestic side. And I think besides external risk, we should also put some weight on downside risks, particularly in the property sector.
About the credit bubble concerns?
Well, credit bubble, we do see that the last fiscal stimulus package has been injecting about 30% of the credit stock, meaning in 2008, before the fiscal stimulus package, we have about 100% credit stock, but now it's about 130 to 40% of stock. And this is very high relative to other emerging markets. That's why the Chinese government is reluctant to easing very aggressively this time, because there's other policy priorities to be balanced, and the large credit stock hanging in the banking sector is one of the concerns.
Many thanks for joining us today.